people affected by potential tariffs and geopolitics, not to mention the chips in the auto sector today. How do you see through that?
Well, you know, it's so interesting because I think the market really is trying to see through all the tariffs. We've had a lot of tariff noise, of course, during the Trump administration, but some kind of predictions or precursors to that with what we saw President Trump posting on Truth Social, what he said during the campaign trail. And by and large, we've seen a market that's largely looking at tariffs as a negotiating tactic and able to kind of shed it off or not let it impact kind of how the market performs. And I think there's a kind of a missing calculus there that relates to Trump's broader comments around tariffs. He talks a lot about tariffs as a form of federal revenue. He talks a lot about tariffs as a way to even out trade deficits. He talks about tariffs as a way to build manufacturing here in the U.S. And all of those other three elements, beyond the negotiation, which we know is part of this man who has an art of the deal, but all of those other three elements really focus on tariffs that are broad-based and long-lasting. And so I think this is something that the market is potentially going to need to grapple with, not on a case-by-case basis, but at the broad level for markets.
Marta, talk to us specifically about the technology industry's exposure to some of this tariff tit-for-tat. How are you thinking about positioning certain pockets of your tech portfolio going forward?
Well, it's interesting when we think about tariffs with technology. We've spent a lot of time thinking about areas like automotives, but we've spent less time thinking about tariffs with technology. And I think a lot of times investors are looking at areas like tech and expecting some sort of, I guess, get out of jail free card with some carve outs or something along those lines. I don't think that's completely out of line thinking. When we think about one of the incentives that President Trump has is to really make AI and U.S. AI a superpower. And we see a lot of enthusiasm for that within the Trump administration. So I think there's some potential to think that we see tariffs coming at tech and then we see the enthusiasm for AI coming into a bit of a collision course over the course of 2025. But frankly, you know, the devil's in the details, and the details aren't clear at this point in terms of how and where and the impact of the tariffs that we see in technology or the broad market.
Let's zoom out of the United States for a bit. China tech has really rallied, even though it's somewhat lagged when it comes to AI investments coming from the private sector and perhaps even the public sector. How are you advising clients to take advantage of some of that diversification, given they're seeing such a big boost?
Well, you know, China tech is a really interesting investment question. Of course, China stocks in general have been under siege. We've seen weakness really stretching back the past few years, and a lot of that relating to geopolitical risk, relating to regulatory concerns, relating to economic questions as it relates to China tech. And so we're seeing valuations that are pretty cheap. Of course, we've had a rally that's undercut some of those valuations, but still marginally cheaper than they were, you know, if we stretch back our gaze several years ago, pre-pandemic. And you have some really healthy big tech companies in China, some rivals to what we have here in the US. So I think if we're looking at the valuations here at home and they seem a bit stretched to us, and then we cast our gaze to something like the China valuations and they're a bit more approachable, I think a diversified approach isn't a bad strategy when it comes to technology exposure. I think the critical question is thinking about sizing it, because of course you have these overhangs, the geopolitical, the economic, and et cetera, that should adjust the position sizing accordingly.
I just think of China and I think back to the market sell-off we saw in that knee-jerk reaction to the DeepSeek news.
Right.
I just want to think about market reaction forces at the moment, particularly in this age of generative AI. And what was so interesting is we heard from the Fed Vice Chair just speaking for the supervision, indeed, Michael Barr, about potential market manipulation because of generative AI. Just take a listen, Martin.
As they will be directed to maximize profit, Gen AI agents may converge on strategies to maximize returns through coordinated market manipulation, potentially fueling asset bubbles and crashes. Speed, automaticity, and ubiquity could generate new risks at wide scale.
On this show, we talk so much about the investment opportunity into the technology.
Right.
But the technology is having an effect on investment? And how is that affecting you? How are you thinking about risks that come about because of generative AI?
I mean, it's a very important question, and I think AI, as we've seen in different areas, opens up a whole new spectrum of risk. Whether we think about fraud, we think about market manipulation, we think about just misinformation. I think that those risks are real with AI, and I think there is some consideration that valuations haven't really taken into account the downside of AI. We think a lot about the upside. We think especially about the improvement in earnings that we can see, certainly in technology, but for the broad market overall. But we think less about what those risks can be. And I think it's partly because, one, we don't want to think about the risk, but two, it's hard to speculate and it's hard to articulate. But I think that's where smart regulation, smart decisions by the companies themselves, and of course by Washington, are going to really matter in terms of how we see this deployed across the economy.